Economic update. In today's discussion, we'll explore the dual role of cash in our financial lives, its benefits and its pitfalls as a long-term investment option. Recently, amidst the roller coaster ride of the stock market and attractive interest rates, many investors have turned to cash. It's about a crucial time to talk about this because while cash is a safe harbor in stormy market seas, it's not without its challenges. Cash is essential for managing daily expenses and preparing for significant milestones like purchasing a house or helping out covering for the kids, whatever it might be. It's a fundamental component of a well-rounded financial strategy. However, there's a fine line to walk. Holding too much cash might mean missing out on a potential gains from other investments. Over the next few minutes, we'll delve into what investors need to consider about cash and their investment strategy, particularly with the shifting dynamics of today's economic environment. So let's get started. Today, we're taking a closer look at a compelling trend, the significant inflow of money into money market funds in recent years. Money market funds are like temporary parking spots for cash. They invest in short-term, cash-equivalent securities. These funds become particularly popular during times of market uncertainty or when interest rates are high. Both conditions we've seen recently. During the pandemic, many investors shifted their money into these funds seeking stability amidst the turmoil. More recently, with interest rates climbing since 2022, money market funds have become even more attractive. Investors are now channeling funds here to capitalize on higher returns from cash investments. Currently, the total assets in money market funds have soared beyond $6 trillion. Yes, trillion. That's more than twice the average seen in the decade following the global financial crisis. This shift highlights how investors are adapting to the evolving financial landscape, looking for both safety and opportunity in uncertain times. Let's dive deeper into the world of cash investments and understanding their real-world implications, especially in times of high inflation. Even though cash rates are currently higher, it's crucial to realize that they might not fully counteract the effects of inflation. The reason rates are up is precisely because inflation has been elevated recently. Consider this scenario. An investor puts money into the average certificate of deposit, or CD. While the interest rates for CDs have indeed decreased, they still fall short when you factor in inflation. Essentially, inflation is like a hidden tax on your money's buying power, and these higher rates only partially make up for that loss. This leads us to a couple of challenges with keeping too much cash. First, inflation can diminish the real value of the cash income you earn. Secondly, the attractive yields on cash are not permanent. Since cash investments are typically short-term investors must continually reinvest their money and hope that they can secure similarly attractive rates in the future. Reinvestment risk, if you will. This contrasts sharply with longer-term investments like bonds or stocks. For instance, investment-grade corporate bonds are currently offering average yields about 5.5%, which is significantly higher than their past decade's average. Unlike cash, these investments offer a longer-term and potentially more stable income stream in an inflationary environment. Let's take a look at how inflation has impacted investments over the last century, using a simple chart for illustration. Imagine if you had a dollar back in 1926. Due to inflation, that same dollar would need to be $17 today just to buy what it could back then. Now let's compare this to investing that dollar in the stock market, specifically the S&P 500. Fast forward to today, that single dollar invested would have grown to an astonishing $13,000. This historical perspective really puts the long-term power of investing into context. While past performance doesn't guarantee future results, it strongly highlights the potential benefits of diversifying your investments beyond just holding cash. Stocks and bonds have not just kept up with inflation, they've dramatically outpaced it. Cash is crucial for immediate needs and is a safety net, but it doesn't provide the growth that a balance of stocks and bonds can offer over the long term. Thanks for tuning into this discussion. If you're interested in exploring how these insights could impact your financial strategy, don't hesitate to reach out. We're always here to help and look forward to assisting you in navigating your investment journey.